VAT, three little letters that scare businesses everywhere. Is it a tax on companies? On consumers? On both? And why do governments love it so much? Today, let's demystify value-added tax, the system that powers trillions in global trade and affects almost every transaction you make. Welcome back to Ask the Customs Manager, where tricky trade and tax issues are simplified into practical strategies for your business. In this video, I'll explain exactly how VAT works, why countries use it, what it means for importers and exporters, and give you a practical example you can apply in your business today. VAT, or value-added tax, is a tax on consumption. Unlike an income tax, which takes from your wages, or a sales tax, which hits at the final checkout, VAT is collected in chunks at every stage of a product's journey. Each business in the chain adds tax only on the value they add. That's why it's called value added. The system spreads the tax across producers, manufacturers, wholesalers, and retailers, but the final burden is carried by the consumer who buys the finished good. Let's take an example. 1. A farmer sells wheat to a miller for $100, plus 20% VAT. The farmer charges $120, but pays $20 to the government. 2. The miller turns it into flour, sells to a baker for $200 plus 20% VAT equals $240. The miller owes $40 VAT, but can deduct the $20 she already paid. She sends only $20 net to the government. 3. The baker makes bread, sells to the supermarket for $400 plus 20% VAT equals $480. Same deal. He charges $80 VAT, deducts $40 paid earlier, and passes $40 net. 4. Finally, the supermarket sells to the consumer for $600 plus 20% VAT equals $720. It collects $120 VAT, deducts $80 already paid, and pays $40 net. In the end, at each step, businesses only pay VAT on their added value. The government collects $20 plus $20 plus $40 plus $40 equals $120, exactly 20% of the final consumer price. Governments prefer VAT because it's harder to evade than sales tax. Since each business gets credit for VAT they've already paid, everyone demands proper receipts and invoices, making fraud more difficult. It also generates steady income because it's applied broadly on almost all goods and services. But here's the catch: VAT is an administrative headache. You may collect more than you pay, or pay more than you collect, which means constant paperwork and balancing. Cross-border trade makes it even trickier. Imports often require VAT upfront at customs, which can squeeze cash flow until you reclaim it. For exporters, goods often leave VAT-free, but refunds from governments can take months. In the EU and many other countries, VAT is charged at import. If you import machinery, you pay VAT on arrival, even if you'll eventually reclaim it. Some countries allow postponed accounting, so you don't front cash at customs, but not all do. Understanding the local VAT rules is essential. Otherwise, your goods can get held up at the border or your finances tied up in reclaimed paperwork. That's why compliance managers obsess over VAT, because a small mistake can freeze up big shipments. To simplify VAT in your mind, remember 3 rules. 1. It's a tax on consumption. The consumer carries the ultimate burden. 2. Each business in the chain collects VAT but then reclaims the portion they already paid downstream. 3. For importers and exporters, VAT is as much a cash flow problem as a tax problem, so preparation and paperwork are everything. If this breakdown finally made VAT click for you, hit like so others can find it too. And subscribe to Ask the Customs Manager. We take the world's toughest trade and tax topics and make them simple, clear, and practical. Thanks for watching. Remember, VAT is complicated in practice, but simple in theory. It's just a system of passing the tax along the chain until it lands in the hands of the final consumer. Master the basics, and you'll save your business time, stress, and money. Until next time, happy trading.